guys, and welcome to Mentini's YouTube channel. My name is Alan Anandan. I'm a CFA charter holder, and I've about 12 years of experience training students getting into finance jobs, and that's exactly what the motto is also of Mentini Careers. In this video, let me tell you what exactly we're going to be covering. So we're going to be covering the expectation versus reality in the interview, and I am sure that a lot of you is going to relate with that statement. Second is I'm going to give you Excel tips on preparation, as well as tell you the kind of cases which are asked in a finance interview. I'm also going to be talking about specific valuation cases which get covered in interviews when you apply across jobs in India. And finally, I'm going to give you a do's and don'ts which you can follow for the interview. And watch the video till the end, because at the end I'm also going to give you a question bank of top 40 questions which are actually asked in an interview, which you can actually go through in your preparation to start your career in finance. So let's begin, and first talking about expectation versus reality. Now, what do I mean by expectation versus reality is the fact that when you are putting your preparation for your interview, you have to put two tangents. One is education and one is the corporate. Now, most of the times what happens is when we are getting educated in colleges or courses that you're doing, you might be learning Microsoft PowerPoint, you might be learning management accounting, you might be learning financial accounting. And also maybe you might say that, yes, I also have learned Microsoft Excel, you have also learned corporate finance, and also maybe ratio analysis. But the problem is, in the interview, what we miss out is that the interview does not ask for these topics to be learned, but in fact the application. So for example, instead of Microsoft PowerPoint, the expectation in the interview is to give a presentation which actually talks about the problems that it can solve. Secondly, when we're talking about financial accounting, the interview really does not ask you for double entries, but it actually asks for conclusive research. In the same way, when somebody is learning financial modeling, the objective is not to learn financial modeling, but in reality, what the actual expectation is the depth understanding of business. That means you can understand various industries, you can break it down, you can talk about conclusive things which the business is doing, you can also talk about the evaluation. Similarly, when we are talking about ratio analysis, for example, that you might have learned in your MBA colleges, but in reality, in the interview, what the interviewer is expecting is how are you going to use these ratios to filter out businesses so that you can research further. And that's exactly what we're going to be presenting in this session. So let's begin. Okay, so here we go, and we start with the Excel application. As I was saying, the expectation in the real interviews is not that you know Excel, but whether you can actually apply Excel, right? So if you see here, this is one of the cases which have come for an equity research case for a finance interview. And you can see here, you've got lots of data here, but that's not the point. But if you see here, the first question they're asking us is there are 7 cells in the table below where data has been entered incorrectly. Highlight the cells that you believe that is in red. Now, you might wonder that, okay, you have the cell, you probably know a lot about Excel, but can you actually identify the 7 misrepresented data or incorrect data quickly, right? So now probably this is not even related to formulas, right? So probably this is just related to conditional formatting. So what the easiest way to solve this is to just use conditional formatting and use data bars, which can give you a quick chart-like structure, which shows you data which is probably not correct because the values are too high, right? So if you see here, let's look at individual data here. Now, if you look at for UK, right? So if you look at UK, 10,323 probably can be an incorrect value because there's a certain blip increase. Then you can see here in case of Germany, there's one data point which seems to be a little not fit, 9235. So basically what you're trying to identify is any outlier values, right? So for example, here you've got 146 in case of the global values. So there are 2 values which seems a little inappropriate, right? So there's the first error, there's the second error, could be an error. I'm not saying that this is the error, but it's much easier to identify this way than actually using a formula, right? So there's 1, there's 2 here, then there's 3 here, then there's 4 here, right? Then there's 5, 6, and 7. So maybe one of them probably is not true, because if you see here, 1199 doesn't seem to be actually wrong. But you can clearly see here that 9235 seems to be wrong, 10,323 can be wrong. These 2 values definitely need further investigations, right? If you quickly check here, 89,424 obviously doesn't look normal. 76,198 also doesn't look normal. So this is first two errors, 1, 2 here. And if you go to the left side on the global values, 134 and 146, so there are 4 errors we can clearly identify. Then there's the fifth error, 117938. So that's your fifth error. Then if you can probably look at sixth and probably seventh, right? So the point is not being right or wrong, but the idea is how do you approach this, answers, right? I mean, how do you approach these problems? So in the interview, what is exactly expected is whether you can bring this together in solving some problems, right? Now, so I mean, probably you already knew conditional formatting, right? But can you apply it to real life scenarios? And this is exactly what a real life scenario looks like, right? And of course, whenever you get these cases, be aware to first arrange the data in a certain order so that the values, even if they are wrong, you'll not be able to identify, because if you're looking at 2009 compared to 2007, the values obviously will be higher, right? Look at this, sort the data so that the earliest dates appear on the top. So this is pretty simple. I mean, you've already done it here. So you go to data, you go to filter, and you arrange it from the oldest to the newest, right? Now, in fact, this second question is actually very useful for calculating the third question, which is on creating a line chart showing how turnover in the US, which is this, and the UK, okay, changes over time. Now, if you look here, there's a thing called as the index chart. Now, again, this is where probably you know how to create a line chart, but do you know how to create an index, right? So what we mean by index is, because these two values, 96787 and 9302, obviously are starting at a very different value level itself, right? Because 96,000, I mean, if you look at, in fact, if you look at UK, it's like US is almost 10 times, right? So when you create a chart, this will not probably look comparable. So then what you do is you create an index. So you try to get all the values. I'll remove this filter so you can actually see it, UK, right? And there's the US, right? So we make them start at 100, okay? So manually create 100, okay? And now based on how these values are changing across time, these index values will change. So then the chart will look actually much more comparable, right? So let me actually make this, okay? So there you go. So we're going to increase 100 by how much these values are actually changing. So in case of US, the value is 86,943 divided by this -1. So there you go. That's the percentage change. And what we're going to do is now we want to increase this, right? So F212, basically 100 into 1 plus this, right? So the values will change in this order, okay? Except the values, oh, I'm so sorry. So into 1 plus, now I'm going to increase the index value by how much the turnover has changed. So how much has the turnover changed? 86,943 divided by this 96,787 -1 and close the bracket, right? There you go. So now the index values has changed to 100, and you can just drag the formula here and double click it so that we get the values for all the years. Now, let me show you how the chart will actually differ, right? So first I'll make it directly for US and UK with the existing values and with an index chart. So you can actually point out what the differences are, right? Now, let's just remove all the other parts. So Western Europe, I'll remove it. Global also, I'll remove it. Now, if you are actually just comparing US and UK, this is how it would look without the index, right? Now, let me show you how it will probably look if you had used, in fact, the index chart, right? So there you go. That's the index. I will just remove the US and UK previous ones without the indexation, right? And we'll just stick with, okay. So that's the index value. Now you can clearly see this is much more comparable, right? So you can see here 2 blips. That's basically nothing but the errors in the values that we actually identified before. But you can see here it's much more comparable. This is the index chart. Now, of course, you know how to create line chart, but do you know how to make comparisons, real life comparisons of data? So that's what is expected in the interview as opposed to what just knowing Excel, right? Okay, so let's look at the calculate the difference in turnover for US and UK. Okay, so they're talking about difference in turnover for US and UK in percentage terms between 2009 and 10. So of course 2009 and 2010. So now you need to really think about how you really want to do this. So we could do is, you could call it US and UK, and we could just sum up values for US and UK for these specific years. Okay, so sum ifs. So now this is where you need to come up with that idea that I need to use sum ifs, right? So that requires practice, nothing else, just need practice. Okay, so I sum up sum range, and now what's my criteria range? My criteria range is actually date. Okay, that's my date. So I'll put a dollar sign for the dates, and I'm gonna write here greater than. Now look at here, these are all dates, right? So 01 2009. Okay, and comma, again I'm going to select the same criteria range. I'm going to put a dollar sign to that, and I'm going to write less than 12 2010. I mean, we could obviously define what is the specific date that should be used, and what I'm going to do is I'm going to unselect this so that we can actually use the same formula for even the UK calculation. Okay, so I'm just going to get rid of the dollar signs. There you go. All right, so that's US. Okay, and let me just copy it to the right. What I'll do is I'll just copy it here, and I'm going to just select UK. There you go. Okay, so in between 2009 and 10, so I mean this could be actually the total 2009 to 2010 values for the turnover. Now you could find out the difference very easy, right? So of course US is much more higher, so that's the difference, right? In terms of percentage, if you want to find out, then you just find out, okay, what is how much is US higher than UK? -1. And so that's about close to about 500%, right? So that's how you actually calculate. That's how you want to learn how to use Excel, or learn Excel in terms of into preparation, rather than just knowing I know how to use conditional formatting, or I know how to use VLOOKUP. Because in the real world, it does not work like that, because you have to get your skills together in order to apply in data scenarios, right? And as a finance aspirant who will be working in the finance field, you would come across such situations every day. And if you do not practice this way, you will eventually get it, but it will be too late, because probably there will be someone who already knows this, and then probably that person will enjoy the fruits of having such skills, right? All right, so let's take up the next case on financial statement analysis. Financial statement analysis. Now, if you, irrespective of whether you've done BCom, whether you've done MBA, whether you've done CFA, it doesn't really matter whether you have done any of these qualifications, but the question is, what can you apply in real life scenario? And just like we saw in Excel, the same thing is also going to happen with financial statements. Now, as an analyst, you really don't care much about accounting regulations, but what you actually care about is whether you understand the three statements or not. And one frequent place where interviews tend to ask or test students is whether they understand the linkages between these three statements. So you can see here, there are three statements: profit and loss statement, cash flow statement, and balance sheet, right? Now, usually when you are a financial analyst, you will be creating such financial statements, and frequently your balance sheets are not going to tally, right? So a person who is capable of tallying the balance sheet, an incorrect balance sheet, obviously knows the interlinkages between the three statements, let alone the advanced applications, right? So frequently interviews will give you such cases, specifically in equity research, where they expect you to solve such cases in limited amount of time. So you can see here balance sheet is not tallying. So if you see here, this is third quarter of 13, the balance sheet does not tally with 140, 506, and in total 2013 it doesn't tally with about 476. Now the first place to look at is in fact in the balance sheet itself. And most likely you have to understand, how does a balance sheet value actually change across periods, right? So it can either happen through the cash values, because the cash values in the balance sheet this values, right, tend to come from the cash flow statement itself. You can see here, right? So that's one area of change, right? Second is fixed assets. If the company has invested, you can see here the company has been investing about 100 million in capex. So that is also a place where the balance sheet tends to have or get a change. Thirdly, you can clearly see in your equity values, your values will change using retained earnings, because the profit net income tends to come to the balance sheet in retained earnings. So we can go to the income statement and we can see there are some values of 25 and 50 which is coming up, right? You can clearly see here, right? So 25, 55, and we also have a difference of 25. So let's start with the first quarter. So the first quarter values are fine. It's coming as 25, 50 and 25. And let's look, the values are correct, right? In second year also, 50 and 25, the values are correct. But if you see in 3 years, in one period, the depreciation and amortization has actually been taken as negative, right? Which doesn't make really sense, because if I see here, there's a negative sign which is put here, but there's no negative sign here to add it up. So I'm going to copy that to the right and now make the changes, right? So now at least the depreciation amortization calculation is correct, right? And also look at the fourth quarter values, which is 50, 55 and 50, right? So that's about 105. And just add up, that's about 340. And let's look if the same values also come up for now. So there you go. That's the problem, right? If you here see 215 plus 100, that comes up to be 315. But in our cash flow statement, it comes up to be 340. Now, if you see for 4 quarters, in most of the quarters, what was happening is that the values were in amortization is 25, but for one specific year, for one specific quarter, the amortization is 25. So maybe what we do is we try to change this into 25. And if you see, only there's one quarter in which the depreciation is about 55. So if I actually adjust this to minus 50 and then I add up, then it comes to 315. So that was maybe just a typical typo error which has happened in depreciation and amortization. And if I come back to the balance sheet or the cash flow statement actually, and if you now see the depreciation and amortization values, it is matching at 315, and this also matches to 315. And also in cash flow statement, if you look at, it should come to about 315, so which matches, right? So now at least the depreciation and amortization values are correct. Now what we can do is, just related to this in the balance sheet, let's look at whether the calculations for fixed assets end of period after depreciation is actually happening correct. The difference of 5 that is actually happening from 2012, and you can actually see here that the BOP fixed assets actually 3005, but it's supposed to be for the 2012 end. So that's where the error is coming from. So this is supposed to be 3000, and you can clearly see that once we do that, right, so this becomes 3000, and if we sum this up, right, that's 3020. And I'll just try to continue this calculation, right? So that's your 3045, 3045, 3065, 3085, and this becomes actually your beginning EOP and your 3085. We are just left with the fourth quarter of 13 expected to be corrected and 341. So now we can clearly see, we can go and try to find out where that 341 value is actually coming from. So we can just check if the retained earning calculation is actually happening correctly now, and there is a problem here, if you see, right? So until third quarter 2013, we were adding net income and we were reducing the dividends, but in the fourth quarter, we have not done the calculation. We've just selected as the last year's, right? So what I will do is I'll just extend this calculation of equity to the fourth quarter, and you can see here it automatically balances, right? And for the fourth quarter 2013 values expected, it should be actually the equity of 2012 plus the total net income of 2013. So I'm going to add the net income, right? And I'm going to reduce the dividends, which is the entire dividends, which is nothing but 341. And let's see if the balance sheet tallies. And there you go. So that's how you actually solve such questions, by first identifying where the error is, right? First in the balance sheet, whether it's happening in cash, then you go ahead and try to find out in fixed assets, and then you find out in whether there are any mistakes in the recurring calculations like equity, which I just showed here. And that's how you solve such questions. So this is very important in terms of the interview to know how these linkages are. And you can clearly see that if you just know financial accounting but you don't know how these are linked in the real life scenario in case of such models, then probably your interview will not happen as you are expecting it to be. All right, moving on now in trying to understand in terms of the valuation questions which might actually come in the interview. And again, the preparation mistake is to spend too much time trying to just know how to do DCF rather than the crux of what is actually required before it. Because the DCF calculation that you actually do at the end is a very small part of the entire model making process. The main process that is actually done is to actually create and understand the business revenue drivers. So, for example, this is one of the cases which is a public listed company, Netflix, and they have given you the revenue models. They have given you the details about all that, the revenue, how the revenue is coming up, and you can also access the annual reports of the company and the quarterly reports of the company, and you're expected to make a full-scale model on the company. Now, the problem is that if you have focused too much on just, the valuation part of the model, and if you just do a YOY growth rate kind of a model, and you do not really understand how to break down the business into price into quantity, then you will be up for a surprise that your models don't actually get shortlisted. So you need to spend more time trying to in the financial modeling process, or if you're learning financial modeling process, you need to spend more time trying to understand the business. Now, what do I mean by understand the business? That, for example, if we were to go through some data points of, let's say Netflix itself, how would you forecast the revenue for, Netflix? How would you break down the business, right? So, for example, if they are generating this $734 million of revenue, how can you divide this into price into quantity? Now, you might just say the number of subscribers multiplied by what they're giving, but is the data really available for that in the quarterly reports? Because you have to most of the times you will not get the exact price into quantity matrix in their reports. So you need to derive that, right? And that can only happen once you try out different businesses. So what ideally students should be doing is just learn how to do DCF valuation maybe once and then leave that. And most of the time you need to be taking smaller, 1 to 10 cases of different businesses and trying to break down the revenue model for there and try to show how you can actually forecast. That will go a long way for you to actually clear interviews, right? So you need to, you need to get the practice of going through their shareholders report. What are they talking about in terms of the growth in the subscribers? Are there any competitions? So that's the kind of preparation that you need in the valuation cases that you get for companies, right? And that's the basic 3 areas of preparation that I spoke about with real cases. Now I'm going to be taking you through some do's and don'ts, which might be very helpful for you when you finally have given the model and now you are waiting for your interview to actually happen. So what to speak and what not to speak, which can go a long way in increasing your chances of getting inside the company. Right, so do's and don'ts. Let's start with the first slide. Okay, first I'll speak about the don'ts because those are much more important, because even if you don't do the do's, if you are doing the don'ts which can actually piss off or probably turn off the interview, then that's actually not good, guys. So first of all, stop talking too much about your qualification, because it's actually written in your resume already. You don't really talk about which place you are from, what qualifications you have. It's already written here. Speak more about your story or your interest. That will be more interesting and more useful for the interviewer. Salary. Do not ask about the salary. Salaries are offered when the interview is over and the interview will give you the offer. That's the time when you will actually see the salary itself, and that's the time when you actually start discussing about salary. That's a little more mature way of handling an interview. Do not ask about work timings, right? Because it's a very big turn-off. I mean, we have not even started. We have not even decided. We have not even signed the contract, and you're asking about what time you will come back to the office. And that actually shows also might be true, might not be true, but sometimes people can take that as a negative factor, that's saying that the person is really fixed with timings, he's not really flexible in terms of taking up new challenges, right? Do not talk about facilities. I mean, this is not a holiday plan. You're not going for a vacation. There's no hotel that you're asking for, whether there's a spa, whether there's a gym, whether there's a pickup, whether there's a pick drop, whether the timings are at 9, 10, doesn't matter. You have to be open. You are young. You are here to take a challenge. You are here not to be very comfortable, right? So that you don't want to really give that kind of an impression. You can decide that later on. Of course, some things are, important in terms of priority. For example, if you're a woman, if you're a girl, if you're planning to join a new company, security has to be top priority. A good healthy place to work is obviously a priority, but that, of course, you have to do your own diligence. You really don't ask the HR on such questions, right? Third, the final one is designation. It really doesn't matter what designation you get. What matters is your work. So let the designation come by itself. You focus on what kind of work you're getting, right? Let's talk about the do's, right? This is the things which you can actually speak about. So if I'm not speaking about all of these things, what are you going to speak about? So the first thing, you can speak about the clients. I mean, try to understand the businesses, right? What are they, what kind of clients are they? Which country are they from? What is the expectation in terms of, as an analyst from you, right? Ask about the freedom of doing good research, or is it a paid research, mandated to give a yes or a good recommendation, or is it where you are open to doing deep research and providing the truth in your model, right? Talk about your work. What exactly are you going to be working on? Are you going to be working on fixed income products, or are you going to be working on equity products, right? Research them. It's like, you're going to be spending about 8 to 10 hours every day with that employee. You should know about what kind of work culture exists there, right? And also talk about, finally, is there any specific skills that you might be needing apart from obviously what you've tested in the longer run, so that you can do such preparations, right? And if you really want to do all of that while being mentored and obviously being guided into a job, then join our Mentor Me's financial modeling course. It's a 3 months rigorous preparation course which prepares you from day one till the end only for interviews. We do teach financial modeling in that, but the focus is not just to teach financial modeling, because as you might have seen today, it really doesn't matter whether you know financial modeling or no. And as I had promised at the start, here is the link for the financial modeling questions, the top 40 questions, which are much more detailed than what I have actually covered here. And you can check it out and do let me know whether that actually helped. So I'll come back again with another video in the next session. Bye-bye.